If you own bonds or bond mutual funds, you can immediately benefit from changes the Federal Reserve made earlier this year. And here's how. You can avoid a big problem most investors don't see coming, and you can earn the equivalent of 5 years worth of bond interest in a single year. Now, over the next 6 minutes, I'm going to show you the big problem most investors don't see coming. But more importantly, I'll show you an even bigger opportunity for those of us who currently own bonds and bond mutual funds. And I want to start by looking quickly at what alpacas, a couple of very cold winters, and a skydiving cat have in common with us bondholders. Now imagine an alternate universe where a friend convinces you that alpacas are a good investment. He tells you that because their fur makes great sweaters that you can raise them and sell them for big profits. Now you're convinced, so you decide to go all in and buy an alpaca farm. And sure enough, the next 2 winters set records for cold. The demand for alpaca sweaters is higher than it's ever been. You're raking in the dough, and your alpaca farm is turned into a cash cow. But inevitably, winter temps start to go back to normal. I mean, you can't set records every year, right? And demand for alpaca sweaters falls back to earth with the temps. It's all good though. Even though it's not record-breaking, winter is still pretty cold, so you're still making money off your alpacas. And while everything is fine and your alpacas still make you money, in hindsight, when was the very best time to sell your alpaca farm? Well, obviously during those record cold years when demand for your alpacas was higher than it's ever been. Well, if you own bonds or bond mutual funds, that's exactly the place you find yourself right now. Why? Well, because interest rates and bond values move opposite of each other like a teeter-totter. So if interest rates rise, bond values fall just like a teeter-totter. If interest rates fall, bond values rise just like a teeter-totter. Now you might wonder, why is that? Well, it's a simple matter of supply and demand. Imagine you have a $10,000 bond paying 2%. In other words, it pays you $200 in interest each year. If interest rates rise from 2% to 3%, does anyone want a 2% bond anymore? The demand for your bond has gone down, so the value of your bond has gone down. When interest rates go up, the value of bonds and bond mutual funds goes down, like the teeter-totter. Now imagine that instead of going up, interest rates go down from 2% to 1%. Now which do people want more? Your bond paying 2% or a new one paying 1%? The demand for your bond has gone up, and so the value of your bond rises. So when interest rates go down, the value of your bond goes up, just like a teeter-totter. This chart shows interest rates and bond values since 1926, and you can see that the teeter-totter between interest rates and bond values works in real life. Whenever interest rates go down, bond values go up, and when interest rates go up, bond values go down. It's a law of physics in the investment world. Well, in March of this year, the Federal Reserve lowered interest rates to 0, and they reconfirmed their commitment to keep them there in June of this year. Now that's as low as interest rates have been in 5,000 years, which means our bond values are as high as they've been in 5,000 years, and quite frankly, that's as high as they will ever be. Just like the alpaca farm, if we were ever going to sell our bonds, when would be the very best time? Well, now, of course, interest rates will never be lower than 0. This is a once-in-a-lifetime opportunity for bond and bond mutual fund investors who recognize this windfall and get out before everyone else gets the same idea and floods the market. So now that you've cashed out at the exact perfect time, where do you put your money? I mean, you still want it to grow, right? Well, you can't very well put it in the bank. We've all seen what low interest rates mean to CDs and our savings accounts. Well, what about real estate or REITs? Real estate values also move opposite of interest rates, so that's not a good option. Well, what about dividend-paying stocks like utility stocks? We see that they also move opposite of interest rates, so they aren't a good option either. So how about other kinds of stocks? Well, that probably won't work either. Look at what happened with the stock market when interest rates went up between 1966 and 1982. The market did nothing for those 17 years. The reason that happens is that as interest rates rise, the cost of borrowing goes up as well. Companies can't borrow to make capital improvements or stock inventory, and as a result, the value of those companies stays flat. Zooming out and looking at the Dow Jones historical averages, we can see that it's not a one-off phenomenon. It happens regularly. So what can we do? Well, there are alternatives. These alternatives have been around since 1973. They've been used by Fortune 500 companies and Wall Street for decades, and recent changes have made them accessible to Main Street investors. They're called capital protected investments. Investopedia defines them as products that not only provide upward profit potential, they also guarantee the protection of your capital investment. A CPI product claiming 100% capital protection assures that investing $100 will at least allow you to get back the same amount of $100 after the investment period. If the product generates positive returns, say plus 15%, you get the positive return of $115. The CPI concept can give you a safer way to earn the equivalent of 5 years' worth of bond interest in a single year, and your principal is guaranteed whether interest rates go up or down. To learn about these kinds of investments and get any questions you have answered, just click the Schedule a Call button on the bottom of the email you received. A calendar will pop up where you can select a day and time for a quick 15 to 20-minute phone call. On that call, we'll walk you through how to determine the current value of your bond and bond mutual funds, and walk you through the different types of capital protected investments that are available to you. It's free, it's simple, and it's easy to get your questions answered. Just click the Schedule a Call button on the bottom of this email to schedule your 15-minute call.